Hey everyone, me Kevin here. We've got to talk about my margin. So, in case you don't know, margin is just debt against stocks, which I really hate debt against stocks because of a few reasons. First of all, if the market falls substantially, the banks, whoever's lending you the money, a brokerage, could just sell your stocks at the bottom of the market, which kind of sucks. I don't like the idea of margin liquidations. This is really different from like 30-year fixed rate debt in real estate, where even if the market falls, I don't have to worry about it. As long as I make my payment, as long as I got tenants, or if a tenant's got to leave and I got to find another tenant, whatever. Obviously, that's a whole risk-based video for real estate. We could do that separately. But anyway, with real estate, I don't care if market values fall. As long as the payment is made, I don't get a phone call from the bank. They just leave me alone. It's wonderful. And after 30 years, the properties are paid off and I owe them free and clear, no debt. It's amazing. With margin, it's just not like that. It's not like that. Market goes down and you get margin called and you don't got the extra money. Boom, they sell you at bottom and that sucks. that's real bad. But now, I wasn't at a level of margin that should have been close to a margin call, right? I mean, I've been saying that I've been paying down my margin. I sold stocks in February before the crash to start paying down my margin. And I did have a private investment opportunity that bumped my margin back up from 20% to like 29% right before the crash, which kind of sucked because then my margin got to like 46, 47% during the crash. But I noticed something over these last 3 or 4 weeks as I've been not only adding to some of my favorite high conviction stocks, but also as I've been paying down margin with extra money that I have, I noticed something. And it's something that's pretty toxic when it comes to margin. When you have a bunch of margin outstanding, whether that's 10% of your portfolio or 20% of your portfolio, or it's 80% of your portfolio, or you're just looking at it and you're going, oh damn, that's a big number, which was my case. My portfolio at the time was like $23 million or whatever with like, no, it was probably closer to like 23 and a half, somewhere around 23 and a half million dollars with $6 million in margin. I'm like, oh, damn, $6 million in margin. I'm like, what happens if the poo-poo hit the fan and then all of a sudden like, yo, you got that 6 mil? Well, can we work something out? It's I'll tell you, just like percentage wise, I was looking at my portfolio. I'm like 20%. I'm at 22.8%. Whatever, big deal. But then numbers wise, it's like, dude, oh man, the weight of that debt is insane. And here's what I actually mean by this, and then I'm going to tell you what happened. So, when the market is falling, a lot of people get really anxious because they see their portfolio value going down. I've trained myself really well not to care about my portfolio value going down because I've seen it go from next to nothing to what it is now, which is, I think, absolutely incredible in a short amount of time. And I thank the gods for that. I knock on wood for that. I'm so grateful for that. But anyway, I mean, look, obviously the last year was phenomenal. I turned, a $700,000 portfolio into one that's, well, worth, well over $18 million. It's crazy. And that's net of all the margin. So anyway, the problem that I found is when you have a lot of margin debt outstanding and the market falls, you don't really care so much about your portfolio, like, oh, deal, whatever, the stock went down, it's not that big of a deal. But what starts really wearing on you is the psychology of, man, I should really be staying at that 20% margin. Then you go work and you make money and you get paid and you're like, oh, cool, I got some extra money. And every time I used to get extra money, I used to get really excited because it's like, oh, sweet, it's payday. Let's go buy stocks. And I was excited to buy stocks. Even when the market was falling, I'm like, yeah, go buy stocks, go buy stocks. It was really fun to buy stocks. But lately, it's kind of been one of those things where like I get paid and it's like, okay, here's this money. And you pay margin off with it because you're like, oh, I want to get to that 20% margin. And it literally felt like I had this like big wine barrel full full of wine called margin. They should have a wine called margin. And then maybe another one called margin call. But anyway, this big wine barrel. And then I'd get paid. And it was like, oh, cool, I get to pay off my margin. And it really felt like I took like a dentist drill and drilled a little hole into the side of the barrel, and I was allowed to let the wine leak out of the barrel for like 2 seconds. So it was kind of like, bloop, okay, well, nope, gotta wait to get paid again. Like, it's crazy. Just how big that number got. Like, it really got out of hand. How freaking $6 million in freaking margin. Now look, I have more debt in real estate, but I also have a bigger portfolio in real estate. It's a large real estate portfolio. And for real estate purposes, I'm only somewhere around like 53% leveraged or something, which is pretty low. I mean, some people are leveraged 90% on their entire portfolio, or 80% on the entire thing. That gets a little bit more scary. But leverage on real estate is separate, and we talked about why. But anyway, on margin, it took the fun out of buying stock. It was literally like I felt trapped under the weight of this, yay, I get paid, I get to buy stock. No, Kevin, you gotta go pay off margin. I'm like, this sucks. Like, it's just not fun. Like, when the dip is happening, it's supposed to be fun to buy stocks. But it's not when all you see is margin going up, then you get paid, and it's bloop, and then margin goes up again, right? It's painful. It's very, very painful, especially if you consider like these horrible case scenarios of, okay, well, what happens if there's like a panic again, like a short-term panic, or even a longer-term panic, like a 3 or 6 or 9 month panic. And all of a sudden, you have this mega inflation for a while, and it takes a year or whatever to get things back on course. So, I really got to thinking to myself, you know what? I don't like the weight of the margin. So I decided to make a change. And the first thing that I did when making this change is I wrote down what I believed. What did I believe to be true? And so what I wrote down was that I personally believe that there is a 70 plus % chance we are going to have a strong market rally sometime between now and September of 2022. I'm purposely saying September of 2022, and you'll know why in a moment. I believe we're going to have to me, I believe there's honestly probably less than a 30% chance of us not having that, but I think 70 plus % chance we're going to have a roaring period of time in the stock market between now and September of 2022. I believe it. I believe that inflation is very high now, and it's going to stay high until August and September of 2021. I believe we're going to see an inflection point in inflation going down. And even if we don't see an inflection point in inflation going down, I think the Fed will probably act and be able to rein in inflation. I do believe that. Again, this is my 70 plus % thesis. So if you don't believe that, then that would be, I think that is a possibility. Don't get me wrong. I'm not stupid. Okay, I do think I can be wrong here. But anyway, I believe there's a 70 plus % chance that I'm going to be right. That even if we have inflation, the Fed's going to be able to bring it down. And if we don't have inflation, great. Then at some point between the next 18 months, we got 18 months, I expect there to be a pretty substantial rally in the markets again. Maybe that's not after Q1 earnings for 2021. Maybe it's not even after Q2 earnings. But get to Q3 and Q4 earnings of this year, 2021, or even Q1 of 2022? Come on. I personally believe so strongly the market's going to be booming next year, especially as our economy booms and soars back out of this COVID mess. So I wrote that theory down. Okay, 70 plus % chance that. Then I wrote down 20% chance that the market just trades sideways. We don't get a rally. The market stays tentative. It feels like it's bleeding. It's up a little, it's down a little, and we get this bull crap sideways trading for the next 2 years. Wouldn't be too good, but It's possible. I think that's 20% possible. And then I think there's a 10% chance, actually I think there's less than a 10% chance since there's 70 plus on the other, less than a 10% chance that we will have an extended bear market where we do not see a rally between now and September of 2022, which that I think is crazy. Like I really believe, and if I look back on this and I'm like, I can't believe we didn't have a rally for 18 months, fine, I effed up. That could happen. I think that is a lower than 10% chance. I think we're going to have a very, very, very strong market rally at some point over the next 18 months. So, what did I decide to do? I decided to convert, and just to, I want to make this very clear. I have fully disclosed what I have done and what I'm in the process of completing to all of the course members in the Stocks and Psychology Money Group. If you go in there, if you join the course, use that coupon code down below. It will expire soon again. The price does go up over time. I know you've probably heard in older videos that there were coupons then too, but the price was way lower. The price goes up over time. Like, this is the thing that's guaranteed to go up. It's like the full self-driving beta in Tesla. It will go up. So you may as well lock in the lifetime access earlier. But anyway, in the course, I have broken down the complete action strategy of absolutely everything that I did that I'm about to just give you an overview on. So every single buy and sell and my rationale behind them is broken down in not only a video, but a spreadsheet and multiple posts where I've been discussing this over the last 12 hours. Anyway, for right now, what did I do? All right, so here's the overview of what I did. I sold a crap ton of shares. A lot of shares. Lots. Many shares. And now before you think, oh my gosh, Kevin's a paper-handed weenie baby. No. I actually took on more risk. Yeah, see, that is the opposite of a paper-hander. See, a paper-hander gets out of the market because they're trying to de-risk. In my opinion, an astute investor invests with more risk and takes on more risk when there is pain and blood in the streets. And folks, we have pain and blood in the streets. People are asking me every day, what put option should I buy? What should I short? How do I short the S&P 500? Oh my gosh, hedge funds are shorting. I want to short too. The hedge funds are deleveraging. Everybody else is deleveraging. Oh my gosh, the market's just bleeding down. This is going to keep going. The SEC is investigating SPACs. And oh my gosh, it's just getting worse and worse and worse. Stop. No. All of this, all of that insanity, that vortex of insanity to me, I just compressed and funneled into a better strategy for me. And it's a strategy that actually takes on more risk. I have converted a substantial portion of my portfolio into leaps, long options, long call options on my highest conviction stocks. Probably only about my highest 12 conviction stocks. And I bought leaps in these substantially. These leaps, of course, include some of our favorites like Tesla and Enphase. Of course, I've even got leaps in some of the SPACs that we like on the channel as well. You know them. I'm not going to go through everything right here, but of course, CCIV's in there, GHVI's in there, PINs, Peloton, whatever. They're in there. And the point is, what I'm doing is I'm buying the beginning of 2023 long call options. And because call options, if they're exercised, well, sold before rather than being exercised, if they're sold usually about 6 months out from their expiration, you tend to benefit from about 2-to-1 leverage on the option. So really, I sold a bunch of shares and then bought almost as many shares back that I sold, considering the 2-to-1 leverage that you get with options. But I completely paid off all of my margin. I literally have zero margin right now. And I have to say, it feels freaking awesome. Because when payday rolls around, we all go and shopping again. And I already have a bundle of cash because I oversold a little bit which I got to rebuy some of the things that I oversold. But anyway, I'm going to do that. Anywho, I am really excited to now just buy with cash. Because what this means right now is when I look at my portfolio right now, the portfolio value total, JP Morgan, Webull, Robinhood, M1 Finance, sits at 18.38 million. And folks, 0% margin. 13.4 million of that is made up of long shares, stocks, shares of companies. 27% is made up of long options. Now, where do I get screwed in this? And why do I say I took on more risk? Well, first of all, remember I was at like 22.8% margin. The odds of me getting margin called probably very, very low. I mean, it'd have to go into like Armageddon, probably. Okay, maybe not that bad, but it'd have to be bad to really see a margin call. So the odds of a margin call were low. But the odds that these options go to zero actually exists. And I got a big chunk of money sitting in these options now. So what I've actually done is I've doubled down on my highest conviction plays. I've increased my risk. And here's how this plays out. As long as we have a big fat rally between now and September of 2022, ideally between April 21st of 2022 and September of 2022, so that way I get long-term capital gains, I will sell those options in that 6-month period and buy shares at that point in the future. And so what I've done today is I've actually been able to go shopping at the cheapest prices I've seen in a long time for options, especially on SPACs or even Tesla or Enphase or Square or Google, you name it. Options have just been so cheap because everybody's trying to short do puts. And so I've really enjoyed going in and going shopping. And again, if you want to see exactly what I bought and sold, check out the program link down below. That coupon code does expire probably in the next few days. We'll see. But anyway, this is so exciting for me, and I'm jumping up and down over this because it feels really great. Because I am so confident that these long options, even though I'm taking on more risk, I think I'm making the right move because I so strongly believe we're going to rally. Definitely at some point over the next 18 months. Well, 70+% chance, but probably, between the 6 months between April and September of 2022, I think we'll be booming. We'll see. When I transition, we'll see. I know there are some tax implications, but that's okay. I really think this is a really good, it's almost a little bit like a YOLO. And now I don't like saying that because that sounds careless, but I think it's a really educated YOLO. And it's really me putting my money where my mouth is. Because if you've been watching this channel, you've been hearing me say, I think this crap is gonna be ugly for the next 5 to 6 months. So what am I doing? I'm buying options in the crap for the beginning of 2023. And I'm doing that in my highest conviction names. I'm just so bullish. And I'm letting that manifest in this way, while at the same time being debt-free in stocks, debt-frickin-free in stocks. It feels so great. And now I'm actually really excited to, anytime I get paid, anytime I free up money from real estate or whatever, other sources of passive income, folks, I'm going shopping. And I can't wait to take you on the journey. So consider subscribing if you have not yet. Check out the programs down below. You literally, within 2 minutes of you signing up for that Stocks and Psychology of Money group, watch Lecture 1.0, join where the alerts are, and you will see exactly everything that I did today. Folks, I am so excited. It feels great. Thank you so much for being here, folks, and see you in the next video.